Have you ever wondered how the world's most successful investors stay calm during a market crash? What do they know that we don't? In today's video, we're diving deep into the top 8 smart ways to invest during a market crash and how you can protect and grow your wealth even when the market is spiraling. Stick around to discover strategies used by experts that can help you not just survive but thrive during market downturns. So, let's get started. 1. Keep a cash buffer. In times of market volatility, one of the smartest moves you can make is to have a cash buffer. This means keeping a significant amount of cash in highly liquid, low-risk accounts, like high-yield savings accounts or money market funds. Financial experts typically recommend having enough cash to cover at least 4 to 6 months' worth of living expenses. Why is this important? Well, during a market crash, you don't want to be forced to sell your long-term investments at depressed prices just to cover an emergency expense. With a cash buffer, you can ensure that your investments are left untouched and allowed to recover over time, while you still meet your immediate needs. This flexibility also gives you the ability to take advantage of opportunities when the market hits rock bottom and quality assets are available at a discount. The best part is that a cash buffer gives you peace of mind. During a downturn, when others might be panicking and selling, you can sit back, relax, and stay on course with your long-term strategy. By maintaining this safety net, you protect yourself from financial stress and give your wealth the chance to grow steadily over time, no matter what the market is doing. 2. Shift to defensive sectors. When the market crashes, it's essential to protect your portfolio by shifting to more stable sectors. This strategy involves rotating a portion of your investments into defensive sectors, which include companies that provide essential goods and services that people continue to need, no matter the economic climate. These sectors include healthcare, consumer staples, like food, beverages, and hygiene products, and utilities, like electricity, water, and gas. Defensive stocks tend to have more predictable revenue streams and are generally less volatile than cyclical stocks. For example, companies in healthcare, such as pharmaceutical or medical device companies, will continue to thrive because people always need healthcare services, regardless of the economy. Similarly, consumer staples, like food and beverages, remain in demand even during economic downturns. By rotating into these sectors, you can cushion your portfolio from severe market downturns. Even if the broader market is crashing, these defensive sectors provide stability and income, helping protect the value of your investments. 3. Utilize equal-weight ETFs. Instead of focusing solely on market capitalization-weighted ETFs, where the largest companies make up the biggest portion of the index, consider using equal-weighted ETFs. In an equal-weight ETF, every company in the index is allocated the same amount, meaning there is no overrepresentation of the big, well-established companies. This reduces the concentration risk associated with a few mega-cap stocks and provides more exposure to smaller, potentially higher-growth companies. Equal-weight ETFs also force a disciplined approach to portfolio rebalancing. When market conditions shift, the rebalancing process forces you to sell off the high-performing stocks and buy more of the underperforming ones. This ensures that you're consistently investing in undervalued assets, which can pay off over the long term as those stocks recover. 4. Ladder into intermediate-term bonds. One of the most effective strategies during a market crash is to invest in high-quality government and corporate bonds with short to intermediate-term maturities, like bonds with 2 to 5 years until maturity. Bonds tend to be less volatile than stocks and offer stability, making them an excellent counterbalance to the ups and downs of the stock market. When the market crashes, having bonds in your portfolio can protect you from severe losses and provide a steady income stream. As interest rates potentially decline during a recession, the value of existing bonds with higher yields can increase, further benefiting your portfolio. By laddering your bond investments, spreading them across different maturities, you ensure that your portfolio remains liquid while maintaining exposure to fixed income. This method helps reduce risk by ensuring that some of your investments mature sooner, giving you access to funds when you need them. 5. Implement barbell portfolios. A barbell portfolio is one that allocates heavily to 2 extremes: very safe assets and high-growth assets. For example, you might combine low-risk government bonds with a smaller, highly scrutinized allocation to high-conviction growth stocks, such as those in resilient industries like AI or green energy. This strategy works by balancing the potential for high returns from riskier assets with the safety and stability of more conservative ones. The idea behind a barbell portfolio is to capture the growth potential of more volatile assets while simultaneously maintaining a strong buffer of safety. This approach allows you to ride out the volatility of the market while still having the opportunity for significant growth. It's like having the best of both worlds, the safety of bonds and the potential high returns of growth stocks. In times of market turmoil, this strategy ensures that your portfolio is never completely exposed to either extreme risk or safety. You're able to capitalize on market growth without putting all your eggs in one basket. For example, while government bonds or gold may protect your portfolio during a market downturn, stocks in emerging sectors like AI or technology can provide growth when the market recovers. 6. Hedge with gold and commodities. Gold has long been a reliable hedge against economic uncertainty, inflation, and currency devaluation. Allocating a portion of your portfolio to gold and other commodities can protect your wealth during a market crash, as these assets tend to perform well when stocks are in a downturn. For centuries, gold has been seen as a safe haven asset because it maintains its value, especially during times of economic stress. In addition to gold, other commodities, such as industrial metals or energy resources, can provide diversification and serve as a hedge during market volatility. These commodities often increase in value during inflationary periods, offering you a way to preserve purchasing power when the value of money is declining. You can invest in gold and commodities through physical assets, commodity-focused ETFs, or futures contracts. While gold and commodities don't provide income like stocks or bonds, they offer significant value during uncertain times. If you want to reduce risk during a market crash, allocating a portion of your portfolio to these assets can help balance out any losses in other areas. 7. Execute tax loss harvesting. Tax loss harvesting is a strategy that allows you to use market downturns to your advantage by reducing your tax burden. Essentially, you sell investments that have lost value, realizing a capital loss. This loss can then be used to offset any capital gains you've made on other investments, effectively reducing your overall tax bill. In the US, after a 30-day wash sale window, you can repurchase the same or a similar security if desired, allowing you to maintain your portfolio's allocation while also taking advantage of the tax savings. During a market crash, tax loss harvesting becomes particularly useful because you can realize losses at a time when many of your holdings are underperforming. This strategy helps you minimize the impact of market downturns on your portfolio and allows you to keep more of your gains in the long term. By using tax loss harvesting strategically, you can improve your after-tax returns, which can significantly increase your wealth over time. 8. Stay consistent with SIPs. Systematic investment plans, SIPs, are one of the simplest and most effective ways to stay invested during a market crash. SIPs involve making regular, fixed contributions to a retirement account or an ETF savings plan. When the market crashes, your contributions buy more shares at lower prices, which lowers your average purchase cost per share over time. This strategy leverages the concept of dollar-cost averaging, where you invest a fixed amount regularly regardless of market conditions. During a crash, when prices are low, your SIPs allow you to buy more shares for the same investment, positioning you for greater returns when the market eventually recovers. Staying consistent with SIPs means that you're not trying to time the market. Instead, you're focusing on long-term growth, and your disciplined approach will pay off when the market stabilizes. Over time, SIPs can lead to significant wealth accumulation as you consistently invest in your financial future, even during turbulent times. These are the top 8 smart ways to invest during a market crash, strategies that can help you protect your wealth and even thrive when others might be panicking. By keeping a cash buffer, focusing on defensive sectors, utilizing tax-efficient strategies, and maintaining a disciplined investment approach, you can ensure that your financial future is secure, even during volatile times. If you found this video helpful, don't forget to like, share with friends who could benefit from these tips, and subscribe to the channel for more valuable insights on how to make your money work for you. Thanks for watching, and see you in the next video.